You're on the order screen, about to buy SpaceX, and you're staring at the wrong number. Not the share price, the size of your bet. Put 1% of your savings in and it goes to zero. You shrug. Put 10% in and it goes to zero. You've set your life back years. Same company, same crash, same Elon. You're asking, is it a good company? It is. That was never the question. Because a great company and a great investment are not the same thing. And the size of the bet matters more than the pick. 7 questions tell you what your number should be, and 6 of them aren't about SpaceX at all. Get them out of order, and the best company of the decade becomes the worst thing that ever happened to your money. So let me give you all 7, in the order that keeps you safe. Here's what makes this hard. SpaceX is a genuinely great company. It lands rockets that used to crash. Starlink beams internet to places that never had it. But that's the trap. A great company feels like a great buy, so most people stop thinking right there. We're not going to. So here's how we'll spend our time. Almost all of it on you. About 5 minutes on SpaceX itself. That ratio is going to feel backwards. By the end, it'll feel like the only sane way to do this. One quick boundary before we start. This is financial education, not advice for your specific situation. I don't know your debts, your job, or how you sleep at night. You do, so run these numbers against your own life, not mine. Now let's get into the test. Question 1. Have you earned the right to buy this? I don't mean morally, I mean financially. There's a foundation under any speculative bet, and if it's not poured, nothing on top of it is safe. 4 things have to be true. You have an emergency fund, cash you can reach in a day, sized to your own fragility rather than a flat 3 to 6 months, how steady your income is, how fast you'd replace it, who depends on you. And before even that, you've laid the first brick, a small starter cushion. A few $1,000s. So the next surprise doesn't land on a credit card. You don't have high interest debt. Your employer match is captured and you're on track for retirement. Let me make the debt one concrete because it's the one people fight me on. Say you're carrying a credit card balance. The average card charges about 21% a year. That's from the Federal Reserve's most recent reading, early 2026. Pay that balance off and you have locked in a 21% return. Guaranteed, risk-free. There is no speculative stock on Earth that reliably beats a guaranteed 21%. So if you've got a card balance and you're buying SpaceX, you're borrowing at 21 to chase a maybe. That math never works. On the match, that's free money your employer adds when you contribute. If you're leaving it on the table to buy SpaceX, you're skipping an instant return of often 50 or even 100% depending on your plan to chase one that's far from certain. Capture the match first, always. On retirement, our default isn't a vague save 10%. It's 20% of your gross income, and that can include the match. If a match covers 3 points of that, your own slice is 17. That's the target you should be on track for before a dollar goes into anything speculative. Not because 20 is magic, but because if your serious money isn't on track, you're not investing in SpaceX. You're robbing your future self to fund a thrill. Here's the rule for question 1. Fail any of those 4 and you stop. You don't buy SpaceX, not because SpaceX is bad, because you have a foundation problem, and SpaceX can't fix a foundation problem. It can only make it more expensive. Now, this is a fail stop. If you're out here, the other 6 questions are interesting trivia. One clarification because people trip on it. These 4 aren't the full order of operations for your money. They're the gate before speculation. Speculation comes last. So all 4 have to be true before a dollar of this goes anywhere near SpaceX. And let me say this plainly because most of us are here and the videos rarely admit it. If you just ran those 4 and landed on, this isn't for me yet, no shame in that. That is not you losing. That is the test working. The most valuable answer this whole video can give a lot of you is not yet, and here's exactly why. Pay off the card, grab the match, get the foundation poured, and SpaceX will still be a stock you can buy next year. The order screen isn't going anywhere. Still standing? Good. Question 2. Which bucket is this money in? Every dollar you invest belongs in one of a few buckets. There's retirement wealth, the serious money, the money your future depends on. There's speculation, money you're betting on a big idea. There's learning money, small stakes you're paying to understand how markets feel. And there's the lottery ticket bucket, money you've basically already kissed goodbye. Here's what matters. Nothing is wrong with speculation. I speculate. The speculation is a perfectly healthy bucket. What's dangerous is speculation wearing a retirement costume. Picture it. The money you swore was untouchable, the money with your kid's college or your own 65th birthday writing on it, quietly slips out of its bucket one night and places a bet at the table. That's the move that wrecks people, not the bet itself. The bet made with money that was never supposed to be at the table. So before you buy, name the bucket out loud. If you can't say which one this is, that's your answer. You don't have a plan. You have a feeling. Question 3, what are you giving up? Every dollar you put into SpaceX is a dollar you didn't put somewhere else. Economists call that opportunity cost, the value of the road you didn't take. And the road you didn't take here is not nothing. That same dollar could sit in a low-cost index fund, a fund that just owns a tiny piece of hundreds of companies at once. Historically, the broad U.S. market has returned about 10% a year before inflation, which is closer to 7% after inflation eats its share. At 7%, real money roughly doubles every decade. So over 30 years, $1 quietly becomes about 8. That's the boring road. And I want you to sit with how quiet that road is because nobody makes a video about it. It's just your future calmly building itself in the background while the internet screams about the thing it wants you to buy today. Or that dollar could kill debt, or fund a Roth, or sit in a down payment for a house. So the bar for SpaceX isn't, will it go up? Lots of things go up. The bar is, does it beat that boring 8-fold road after you account for the very real chance it doesn't work at all? That phrase, after the risk, is the whole game. A bet that might triple but might also go to 0 is not the same as a steady road that quietly multiplies by 8. You have to weigh the prize against the odds, not just stare at the prize. That's a much higher bar than will it go up, and most people never raise it. And here's a quieter point. If SpaceX truly becomes the company of the decade, index investors aren't permanently locked out. Some big funds, like those tracking the NASDAQ 100, may own it within weeks. The S&P 500 funds will take longer, because the S&P requires steady profits SpaceX doesn't have yet. The point is that boring index money eventually captures some of the winners. You get a sip of that upside without betting the farm on one name. The boring road isn't the road with no exposure to greatness. It's the road that gets some of the greatness without the chance of ruin. Question 4. Do you understand the business and the price? Two different things, and the second one is where almost everybody falls down. Here's the test. If SpaceX dropped 50% tomorrow, could you explain why? Not panic, explain. If the honest answer is, I don't know, the market just did that, then you don't own a thesis. You own a mood, and a mood gets shaken out at the worst possible moment. Start with the business, because what you're buying changed. After the merger, this isn't a pure rocket bet. You're buying rockets, plus Starlink, the satellite internet arm with, as of early 2026, around 10 million subscribers, plus an AI division folded into the company. 3 businesses in one box. Know what's in the box. Now the price. And this is the number the order screen never shows you. By the close of its first trading day, the market valued SpaceX above $2 trillion. But one widely cited credentialed estimate from Morningstar as the stock debuted put the fair value of the business closer to $780 billion. Divide those, and at that price, the market was paying nearly 3 times what that analyst thought the business was worth. Now, fair warning, that $780 billion figure is one analyst's model, not a market consensus. Other people will hand you a higher number, and they may turn out to be right. But you don't need that exact figure to be gospel. You just need to notice that a serious, credentialed estimate sits at roughly a third of the debut price, and to ask why you're so sure that estimate is the one that's wrong. And under that price tag sits a company that, by figures reported around the time of the IPO, was losing something on the order of $5 billion a year. Now, an analyst can be wrong. Markets sometimes see a future the spreadsheet can't, but that's exactly the point of the question. If you're paying nearly 3 times a credentialed estimate, you'd better be able to say out loud why you think that estimate is too low. As Warren Buffett put it, price is what you pay. Value is what you get. Conviction comes from understanding the gap between those two. It does not come from excitement. Quick gut check before we go on. Notice we're 4 questions in, and we've barely talked about rockets. That's not an accident. Keep that in your back pocket. It matters at the end. Question 5. What's the real downside? Most people picture the downside as a rocket blowing up. That's the wrong picture. Here's the right one. And it's the most important sentence in this video. When a price is this high, It already assumes success, which means you don't need a disaster to lose money. You just need disappointment. Sit with that. The stock is priced for everything to go right. So a merely good quarter, not bad, just good, can knock it down. A timeline that slips a year can knock it down. The bar to disappoint a near 3 times valuation is incredibly low because perfection is already baked into the price. Disappointment, not disaster, is what gets you. Then stack the real risks on top. Execution. Can they keep launching at the pace the price assumes? Competition. Starlink isn't the only company racing to put internet satellites in orbit. Amazon's building one too. Regulation. And key person risk. So much of this story rides on one human being, and anything that shakes Elon Musk shakes the price. Here's the clean definition to carry out of this section. Risk is not what you're afraid of. Risk is what could happen that you didn't price in. One more piece, and it's a quiet one. The people who know this company best, early employees, early investors, mostly can't sell yet. They're locked up for now. But that lock doesn't hold forever. In the months after an IPO like this, those shares unlock in waves, and a lot more supply comes to market. Here's why that matters to you. When the people closest to the company finally get to sell at these prices, you have to ask how many of them will, and what that wave of selling does to a stock you're buying at a stretched valuation. That doesn't make them villains. Selling your own shares is normal, but more sellers arriving at a price you already think is rich is something you want to see coming, not get blindsided by. Are you sure today's price already accounts for that? Question 6. How much can you lose without it mattering? This is the one the order screen was really asking you the whole time. And this is where that opening scene pays off. Picture 2 buckets again, but simpler. Core capital is your retirement, your foundation, untouchable. Then there's your speculation sleeve, the small, walled-off slice you can swing with. Money you've decided in advance you could lose to zero. SpaceX lives in that sleeve, or it doesn't belong in your account at all. Now let's make the order screen real. Say you've got $50,000 in savings. Put in 1%, $500. SpaceX goes to zero. You're annoyed for an afternoon. It's a story. Put in 3%, $1,500. It hurts a little. A nice weekend gone, but your life doesn't change. Put in 5%, $2,500. Now it stings. You feel it for a while. Put in 10%, $5,000, and it goes to zero. That's a real wound. That's a setback you carry for months, maybe longer. Same stock, same outcome, same Elon, same bad day. The only thing that changed was the number you typed, and that number decided whether a loss was a shrug or a wound. That's the whole opening scene right there. These aren't recommendations, and I'm not telling you to put in 5%. I'm showing you that the size of the bet matters more than the pick. You can be completely right about SpaceX and still blow up your year by sizing it like a fool. And a big salary doesn't save you here. A bigger paycheck buys a bigger position. It does not buy better judgment. Question 7. What would make you sell? Here's a strange truth. Most people decide how to get in and never decide how to get out. So they sell at the worst possible time, when everyone's panicking, and they hold through the one thing that should have scared them off. So decide your exit before your entry, and decide it for the right reason. You sell because the thesis broke. If Starlink's economics fall apart, if they can't launch at the pace the price needs, if the valuation runs so far past any defensible case that even a believer can't justify it. Those are reasons. You do not sell because Reddit had a bad day or because the stock dropped on a Tuesday for no reason you can name. Volatility is just weather. A broken thesis is a season change. Know which one you're looking at and decide that now while you're calm, not later while you're scared. That's all 7. Now let me close the loop I opened at the very start. Count them again. Have you earned the right to buy? Which bucket? What you're giving up? The downside? How much you can lose? And when you'd sell? 6 questions, and every single one was about you. Only question 4, the business and the price, was actually about SpaceX. 6 about the investor. 1 about the investment. By design, because that's the secret the whole thing was built to teach. The investment matters. The investor matters more. You can hand the exact same stock to 2 people and one builds wealth with it and the other gets wrecked. And the difference isn't the stock. It's everything we just walked through. So let me leave you with the test inside the test. The FOMO premium. Ask yourself, honestly, if nobody had been talking about SpaceX this week, if it hadn't just become the most hyped stock on the planet, would you still want it this badly? If the honest answer is no, then you're not buying an investment. You're buying attention. And attention is the single most expensive thing you can put in a portfolio. There's a reason the most expensive 4 words in investing are, "This time it's different." Every hot stock feels like the exception to every rule. Almost none of them turn out to be. And watch the lottery ticket trap because it's sneakier than it sounds. The danger of a lottery ticket isn't that you might lose a few bucks. It's that the tiny chance of a life-changing win is so seductive you start building plans around it. The smaller the odds of that life-changing return, the more dangerous it is to lean on it. If part of you is quietly counting on SpaceX to be the thing that fixes your finances, stop. That's not a plan. That's a wish with a ticker symbol. And remember which game you're playing. Big concentrated bets are how fortunes get made and how they get destroyed. Concentration creates wealth. Diversification keeps it. One person here is trying to get rich, the other's trying to stay rich. Be honest about which one you are, because they don't play by the same rules. Here's your homework, and it's the whole point of this series. Before you buy anything, SpaceX, Bitcoin, Nvidia, gold, whatever's hot the week you're watching this, run it through these 7 questions. In order. Fail stop at question 1. The stock changes. The test never does. That's why it's worth keeping. So here's what I want in the comments. Tell me your number. After running the test, and be honest, what % would you actually put in, and which question gave you the most trouble? And if you landed on, not yet, I want that too. That's the test working, not failing. I read these and the answers are usually more interesting than the stock. And if a framework you can reuse on every hyped investment for the rest of your life is worth more to you than a hot take that expires next week, subscribe. Because the next thing the whole internet is screaming at you to buy is already coming. I'd like you to be ready for it. I'm Cole. This is the Money Professor. I'll see you in the next one.